It's interesting, when you do a comparison over the last 25 or so years, high yield looks very good versus the equity market. And if you go over longer periods of time, it's a little less return with much less volatility. So high yield gives you a little less than equities if you go back, I think, to kind of the mid-80s, but with much less volatility. If you go back over the last 12 years, which haven't been a particularly robust period for equities, high yield has done much better, and also, once again, with much less volatility. So we have a lot of discussions with this when we talk to advisors or when we talk to institutional clients, because one of the questions comes up is, I want to add to fixed income, I want to buy high yield. And obviously, high yield funds are part of the fixed income landscape, but they have a different risk profile driven by credit risk as opposed to rate risk than a lot of the fixed income products. So when we talk about it, I think it's interesting to make that case, comparing it to equities and some other things. And I think it has a nice place kind of sandwiched between some of the less risky parts of fixed income and kind of more opportunistic, or quite frankly better returning than other parts of the equity market. And that's kind of, I think, the way that you can think about where it fits in. High yield at 700 basis points spread, or 7% over treasuries, is well above average spreads. I think the fundamental landscape is quite good. Defaults will be below average for a persistent period of time. And against a backdrop of a lot of macroeconomic uncertainty, I still think it's kind of a really nice place sandwiched into portfolios, both for pension funds, asset allocation accounts, or just individual investors.
And I'd add to that, the debate right now really is, how robust is the growth in the world? And it seems, unfortunately, that it's going to be too slow for many of the economies. And that's really an issue for equity investors, because they're the ones most levered to that growth. But fortunately, in high yield, we don't need a 3 or 4% growth in GDP for our companies to do reasonably well. And in fact, if growth is potentially a little bit slower, corporate management teams are going to generally be conservative, especially ones who carry a lot of debt, like the companies we invest in. And they're more likely to maybe try to pay off their debt a little faster, keep a little bit more cash in the bank, be a little less quick to make an acquisition or to build a new factory or hire a lot of people, which has its implications for the overall economy, yes, but for the specific companies we're invested in, that can be very good from a credit standpoint.
It's interesting, if you go back to other periods of kind of lower growth, high yield has done very well in those periods versus equities. So once again, kind of speaks to that, what Norm was saying. I think the other thing it's almost a little counterintuitive again, because of a lot of the macroeconomic challenges out there, credit investors, credit bond investors have gotten a lot of benefit of companies saying, you know what, it's an uncertain world. I'd rather carry less debt. I don't know if I'm going to be able to ship goods or the same kind of shipments into Europe or whatever it is. So some of the macro uncertainties created more conservative behavior in the executive suites or in the boardrooms. And ultimately, credit investors, that's very beneficial to the way that we think about the world and actually just stable or even tightening spreads.
And another good thing about bonds is that we get paid while we're waiting. 7 or 8% yield on our bonds. So even if things are worse a year from now, if you add in that 7 or 8% yield that we've clipped in the meantime, we could be substantially better off than having done nothing or sitting in cash, which doesn't return anything right now.